This video will walk you through math skill number 4, credit cost calculations from the Master Money Financial Skills Workbook. So these calculations are designed to help you figure out how much a loan will cost you, and then you can take how much the loan costs and add it to how much your purchase cost to figure out how much you're going to pay overall. This is a useful tool for figuring out how to reduce how much you have to pay to buy things like houses and cars. So let's go through practice problem number 1. So suppose John has $2,000 on his credit card at 20% interest with a required minimum payment of $35 per month. If he pays the minimum each month, how much interest or finance charges does he pay? Okay, so step 1, we need to calculate our loan amount. And our loan amount is equal to the sales price. So the sales price is $2,000 here. That's the price of the things that he bought. Now, because it's a credit card, he may have bought lots of different things, a bunch of small things. If this was a car or a house problem, it would be the price of the house or the price of the car. But it's a credit card, so this is the total amount that he's borrowed, minus our down payment. Now, there's no down payment here. We don't do down payments on credit cards. It's not a thing. Plus, the problem just doesn't say it. It doesn't say he has a down payment. So we assume that there's none. So that means his loan amount is equal to $2,000. This loan amount then becomes our present value for our time value of money calculation. That's how much he's receiving up front. He wants to pay it off. He's going to make a payment of $35 per month. We don't know how long it's going to pay off. So this is what we're going to be looking for. And his interest rate is 20% per year. Okay, so when you enter that into your calculator, you should get an N of 184.1894 months. So we got to do step 2 here because we need payment and N for step 3. And we didn't know N from the problem, right? The problem did not tell us how long he's going to be paying this off for. So we needed to make sure that we had that. So step 3, the total amount we paid on the loan, the total loan payments, is payment 35 times N, 184.1894. So 35 times 184 is $6,446.63. So that's the total amount he's paid on the loan. Now if we want to figure out how much interest, we need to simply subtract the loan amount of $2,000 and we get $4,446.63. That's the total interest he'll pay on the credit card. Now if you were to continue this to step 5 and you want to, okay, what's the total cost? Then we would take the sales price of $2,000 and add our interest here of $4,446. So basically what this is saying is that he's going to pay $4,400. So what he needs to do then is ask himself, before he incurs this debt, before he uses his credit card to charge this money, is it worth paying an extra $4,400 to have these things now? How much earlier does the credit card enable him to buy them? Right? If he could buy it next month, then he would be paying $4,400 in interest to get this item 1 month sooner. But if it would take him 4 or 5 years, maybe, then he'd be paying $4,400 to get 4 or 5 years earlier on this purchase. And then he just has to sit down and decide, is this amount of money, is it worth it? Is it worth it? All right, let's do example problem number 2. So Jody just bought a new car. She paid $21,000 for the car and used the $2,500 trade-in value of her old car as a down payment. If her interest rate is 6.5% for 5 years, what is the total cost of buying the car? So again, we'll just go through our process. Step 1, loan amount equals sales price. So how much did you pay for the car? $21,000 minus the down payment. She's going to sell her old car and use it as a down payment. So she pays $2,500 as a down payment. That gives her a loan amount of $18,500. That's what a down payment does. It reduces how much you have to borrow. And when you borrow less, you pay less. Okay, so this then is the amount to borrow. This is how much she's going to borrow. And in step 2, that becomes our present value because that's how much she's borrowing. She's going to pay the loan off. Now we know N in this case, right? But we don't know the payment, right? She doesn't know what her monthly payment is, but she knows what the interest rate is and she knows how long she's going to pay it off. So we're looking for payment. We know N is 5 years. 5 years. And we know that her interest rate is 6.5% per year. Now, we need to convert this to months, right? That was our step 2 from our time value of money. So we'll times it by 12 to get 60 months so that we can calculate a monthly payment. And when you enter that into your calculator, you get $361.97 as the monthly payment. Now this is going to come out of your calculator as a negative number. That doesn't mean it's negative dollars, and that doesn't mean that in step 3 you use a negative value. It just tells you the direction. The money's coming out of her pocket and going away. In this case, it's going to the bank. And so that negative sign just tells you the direction. But you're not going to use the negative when you get to step 3. So step 3, our total loan payments is payment, PMT, times N of 60. Right, just grab these two numbers and multiply them together. And you get total loan payments, $21,718. So that's the total amount of money she's going to pay on the loan. But part of this is principal, repaying how much she borrowed, and part of it is interest that she was charged. So step 4 and 5 are all about separating out the interest from the principal. So in step 4, the total interest or the finance charge is the total loan payment, $21,718, minus the amount we borrowed, the loan amount. Okay, so if you take the total amount that we pay and subtract how much we actually borrowed, everything left over is interest, so $3,218. And then step 5, to get the total cost, we'll do the finance charge plus the sales price. That gives you $24,218. Now, not every problem or circumstance may necessarily require you to go to step 5 in real life. For example, our problem number 1 we just did, we didn't actually have to go here, right? We didn't have to go to step 5 because we already had the number up here. So in some circumstances, you may not need every step, but if you're not sure whether you should do it or not, whether it's right or wrong, go all the way through all 5 steps. You will always get the right answer if you go through all 5 steps. And in some cases, you will get very different total costs. You can have circumstances where you pay more in interest but have a lower total cost. That happens a lot with cars when they change the sales price depending on how you pay for the car. For example, if you've heard of 0% financing, or you can get $5,000 cash back, if you've seen commercials for that type of deal, that's them changing the sales price depending on how you pay for it. And when the sales price starts changing, you can get different answers for total interest and total cost. So it is possible that the deal that charges you the most interest might actually cost you less if the sales price has changed in the meantime. But again, if you're just not sure, just do all 5 steps and then base your decision on step 5, and you will never go wrong with the answer to step 5. But this applies and works for credit cards, student loans, car loans, mortgages, any loan that you pay off with regular payments over a fixed period of time. This process will work. Go all the way to step 5 and you'll know exactly how much it will cost.